Hello, my name is Dan Smith and I'm the Head of Marketing and Investor Relations for CARLTON Bonds and Growth Capital Ventures. I'm joined here today by Simon Lenney, Chairman at CARLTON Bonds, and Craig Peterson, Co-Founder and Chief Operating Officer at CARLTON Bonds and Growth Capital Ventures. Simon, Craig, thanks for joining me today.
Hi Dan.
Good morning, Dan.
So we're here to focus on one specific topic today, ISA options for experienced investors. There's clearly a lot to be talking about when it comes to the ISA, especially at this time of year. At the point of recording this, the new tax year is obviously just around the corner, and that comes with a new £20,000 ISA allowance. I'd like to start with a question that's quite high level, but should set the scene for the foundations for this session. Before I do, I will just mention that the information provided here is purely for educational purposes. It isn't intended to be advice and shouldn't be received as such. It's always recommended to take independent financial advice before you make any form of investment. So, cash ISAs, they are synonymous with the wider ISA term, but they're only one option available. For experienced investors, what other options do they have available to invest into within the ISA wrapper? Simon, perhaps we can start with yourself.
Yeah, thanks, Dan. As you say, I think for experienced investors, and for most investors, the cash ISA is probably synonymous with the ISA product itself. But for the experienced investor, there are also options which include a stocks and share ISA, which again allow you to invest into the equity markets under the protection of that same tax wrapper. The third point being the innovative finance ISA. There's two subsections within that. There's a peer-to-peer option, which is proving quite popular within that particular mandate, where both consumer and SME funding is available. And there's also the asset-backed ISA, which does provide the investor with a degree of security throughout the course, although nothing is guaranteed within the IF ISA. And the fourth product is the lifetime ISA.
Perfect. Thanks, Simon. And I guess looking at the options of those that you've just mentioned, the IF ISA is probably the least well known. It can obviously have some similarities to a stocks and shares in terms of kind of risk return profile, but it's very much its own separate product. Craig, perhaps you can give a bit more of an insight into what the IF ISA actually is, what it does, how it can be of interest to experienced investors.
Yeah, thanks Dan. It's as Simon mentioned, it is an investment product, so very different to a cash ISA, which is a savings product. So if you think about an IF ISA, picking up on the points that Simon mentioned, it is very focused on peer-to-peer lending and debt-based securities. So essentially, you're investing into a product where loans are made to underlying projects, or businesses or consumer loans. So there's quite a spread of the different types of underlying investment that an IF ISA can support to generate your returns as an investor. And I think it's quite an interesting product because obviously we're in a low interest rate environment. So if people are sat with cash ISAs that really are not getting the returns that they want, and they're happy to take some investment risk, and that's a really critical point. It is an investment product. So as with all investment products, your capital is at risk, same as a stocks and shares ISA, then it does allow for some portfolio diversification. So for an experienced investor, it's a way to actually look and say, right, cash ISA, safe, £85,000 protected with the Financial Services Compensation Scheme. Whereas if you're happy to shift some of that money into something that's an investment product that's not correlated to the stock market, for example, then the IF ISA can actually be quite a decent way to actually diversify your portfolio and actually support other asset classes, such as consumer loans, business loans, green energy projects, and also development projects. So a lot of IF ISAs will lend money to residential development projects and commercial development projects. So it's quite a decent way of spreading risk and generating returns from different asset classes.
Perfect. Thanks, Craig. Any additional points to mention, Simon?
Well, I think Craig made a really good point in that we are currently, and I would expect it for the the foreseeable short-term future in a very low interest rate environment. So the returns that the experienced investor will be looking at from perhaps cash, focusing purely on a savings type product, is going to be relatively low, but it is safe, covered within the FSCS scheme. However, if you're going to produce your balanced type portfolio across your ISA wrapper, then it does make sense as an investor to perhaps have a slightly higher spread of risk across parts of that portfolio. So the returns that we're seeing across the IF ISA tend to be in the region of between maybe 4% to 8% across the peer-to-peer and the asset-backed type mandate. So it gives that investor a better way of perhaps balancing their returns, but at the same time acknowledging the fact that there is a higher risk involved, and that is purely down to their personal circumstances as to what risk mandates they're actually willing to take.
I think it's really interesting because cash ISAs, IF ISAs, cash ISAs versus the IF ISA or the stocks and shares ISA, two clearly very different products, savings versus investment, and they shouldn't be compared. But it's difficult to get away from the fact that you see headlines about cash ISAs where there are numerous high street banks offering just 0.1% interest on the cash ISA. That's a minute amount of money gained on your investment or savings. If you were saving £20,000, that's £2 a year. It's not a great deal. And again, as you say, it is guaranteed and it is safe. But I'm sure some investors would question whether it's even worth it, the kind of the hassle of putting your money into a cash ISA.
I agree. I think there has to be a balance, and the ISA wrapper is extremely important to any investor because of the tax savings, and I guess it's also fair to say that we will not always be in a low interest rate environment. But if you look at the yield curve for the next 5 years, it's highly likely that we will be. If you look at the yield curve for the last 5 years, it's absolutely positive that we have been. So it's actually, what returns are you looking to get within a 10-year window, dependent upon your personal circumstances. Are you just about to retire, or are you still contributing to your pension fund, or whatever? But I think we're all, as you mentioned, the way that the high street banks and the savings institutions all start to queue up around about now to launch their ISA products. And you go back 5-6 years, everybody was quite excited about the fact that they were, let's see which bank is going to offer the best ISA and where can I move my ISA to. They're all very, very similar, and you're right, 10 basis points to maybe 50 to 45 basis points for a cash on demand type ISA product, and maybe tying up for 18 months to 2 years, you might get up to maybe 75 basis points. And that 75 becomes, in theory, quite attractive. But actually, when you look at what you can do when you consider the wider options across there, and you're right, there is the stocks and share ISA, but for the experienced investor to consider. But the innovative finance ISA kind of delivers a higher return in perhaps a shorter space in time than the stocks and share ISA would do. I always think equity markets, if you don't go into the equity markets in a short-term play, you go into it for the long term, and you plan your investments as you would investing in equities in any way. That would be my point to make.
Definitely. I think it leads really well onto a related point that for experienced investors who do want to incorporate more risk into their portfolio under the ISA wrapper, they've clearly got two options: the stocks and shares ISA and the IF ISA. But what considerations do investors need to be given to each when they are trying to manage the risk with their stocks and shares ISA investments or their IF ISA investments? For example, how would someone explore whether a IF ISA opportunity was the right one for them? Craig, perhaps we can start with yourself and on the IFISA side.
Yeah, I think it's a really, it's a good question, Dan. You know, the IFISAs, there's a lot of different options out there, and we've touched on them earlier. You know, you can have IFISAs that focus on consumer lending, business lending, property or asset-backed lending, and green energy projects. So you've got quite a spread there. And I think there's a number of things to take into account with an IFISA. Understanding the underlying business model and the risk profile of that business model and lending model is critical. So if you're looking at consumer loans and business loans, they'll generally be unsecured lending. You know, and that in itself isn't a bad thing, but it does mean there's no security there. It's obviously down to the credit worthiness then of the businesses and the consumers that the loans are being made to. And obviously, like anything, that can change if you know markets change. We've got a prime example now of what's happening with you know, COVID pandemic. If you then start to look at let's say asset-backed property IFISAs, where there might be a peer-to-peer lending business model or a debt-based security such as a bond, then those do have the downside protection. And I will say it is protection, but it doesn't guarantee returns. But it does give an element of protection to the lender or the investor in this case, and that can be helpful. Obviously, the residential market has performed surprisingly very well during the COVID pandemic, and that's due to the fact that, you know, we've got a really strong demand for housing in the UK, full stop. So understanding that underlying business model is critical, and I think the other thing as well is understanding the team behind the particular IFISA product as well. Whatever they do, they need to be able to demonstrate real experience in the field that they operate in. So I can't stress enough that if I was looking at an IFISA, I'd look, you know, very much at the underlying business model, the team behind it, and ultimately the track record and so on. And I think the other thing to point out as well is generally when you look at rates, Simon touched on that sort of 4% to 8% as being a sort of sensible target return for this type of investment. You will see some that move into double digits. There's a rule of thumb really, and it is a case of, you know, the higher the return, the higher the risk profile. So I would always sort of encourage people to have a good look at anything that looks maybe too good to be true, sometimes can be. So just, you know, a word of caution there on some of the higher sort of rates that are out in that market. But overall, you know, it's certainly a space or a product to look at for experienced investors.
That's really useful, Craig. And I guess, Simon, how does that compare, or what would an experienced investor need to be looking at from a stocks and shares ISA point of view, and how does that compare to the IFISA considerations?
Well, I think it's still a risk product, regardless of you know how we consider a very safe cash home for your cash ISA and for your savings. The stocks and share ISA comes with an element of risk, and also depends upon where you invest within that equity wrapper. But I think the fundamentals of this are, if and we've got a very good example live at the moment. If you go back 18 months and you look at the way the equity markets have performed, not just nationally but globally, and certainly with it across Europe and the UK, with first up of all, we had Brexit to consider, and they had a massive impact on markets. And whilst we were going through the Brexit debate and debacle, along came a COVID pandemic, which absolutely rattled the markets, as you would expect, and that was a global play. So if you then decide, if you had decided 18 months ago or 12 months ago even to invest in the equity markets to make some money in the next 12 months, my guess is, unless you've been extremely astute, you probably haven't made any money, or if you have, you've made it, you know, a small amount, or you have lost part of that investment if you'd invested in a stocks and share ISA. And that's probably a good example. What I'm trying to say is, look, you invest in the equity markets by definition for slightly a longer term, and you're willing to acknowledge the fact that you have that investment, you've made it, and you're going to park it, and that's part of your portfolio. I think that's that would be the fundamental point for any investor. to say I'm into the equity markets, but I'm not going to make a huge amount of money if I'm only in for 6 months or 12 months or 18 months. There's no defined period, but the volatility that we've experienced and continue to experience, the markets are very reactive to anything that might hick a little bit, or a bit of good news where a vaccine is available, and the next day the vaccine mightn't be available, and the market falls. So you've got to accept the fact that that climb will be gradual, because over time, generally markets do increase. So there's no guaranteed return. However, if you're in for the longer term, then it probably will deliver the returns you are expecting, or at least a reasonable return in line with what you're expecting.
So the point there, Simon, about volatility, Craig, from a IFISA perspective, is there a level of volatility that investors need to be aware of or account for, or is that just not the case within an IFISA?
It's different for an IFISA. I mean, volatility, obviously, with stocks and shares, prices fluctuate on an hourly basis. It depends on news flow and what's happening in the markets. An IFISA can be impacted by market conditions, but that doesn't mean it's volatility. It means that returns might be impacted if markets were to really come under pressure. But it's a very different type of product. There are target returns associated with an IFISA that they should never be promoted as guaranteed. So if you see that with any IFISA, I would always sort of raise a question there. So they are target returns. In terms of volatility, it's not the same as the stock market, but there are market conditions that can impact the ability of an ISA to generate those target returns. So that's something to be mindful of. And I think that the key point really, when you start to consider the options as an experienced investor, is the ability to diversify. The good principles of investing are always to build a diversified portfolio. And ultimately, if you can start to look at your different ISA options to achieve that, then that's probably where you start to really make the best of the product and ultimately spread that risk and deal with that volatility, if that makes sense.
It does. Completely, and it's a great comparison between the stocks and shares ISA and IFISA, and really useful, I'm sure, for experienced investors to be aware of. If we just go back to the starting topic of the wider ISA options for experienced investors, we've obviously looked at the products that are available, but if we take a bit of a high level view, what do experienced investors need to be aware of within the ISA wrapper that could be beneficial to them? I know, Craig, you and I spoke recently about ISA transfers. What considerations like ISA transfers should experienced investors be aware of?
So yeah, with that, Dan, it's a really interesting point as well. There's a lot of people I speak to who have got decent ISA portfolios, typically in cash and stocks and shares, and some of them are probably overweight in cash. And experienced investors who have got reasonable portfolios built over the last sort of 10, 15 years, whatever it might be, are sat there thinking, right, what can I do to get a better return from particularly the cash ISAs? And they're happy to take the investment risk. So what they can do is they can transfer money from one ISA to another. And it's actually a much simpler process than people realize. So a lot of the conversations I've been having with some of our investors and experienced investors that are looking to essentially rebalance their portfolios is how can they actually effect a transfer from one to another. And what it's allowing them to do is to look at their particular circumstances. So their age that they're at now, what do they want to achieve from their investment portfolio overall, and how can the ISA wrapper be used to actually create that balanced portfolio that balances risk versus ideal sort of return, and then use the transfer process to actually affect that. So it's a really interesting way for an experienced investor to actually balance a portfolio in line with what they want to achieve. So, for example, if somebody had £100,000 across a number of different ISAs, they could start to look at, the allocation in stocks and shares, maybe some allocation into an IFISA, and then maybe looking at their sort of cash position and just seeing what they want in there as well, and giving a really sort of balanced portfolio.
I think it's probably worth just pointing out that there is a formal process for this, right? And there's a huge difference between withdrawing your money on a morning and investing it into a new ISA on the afternoon compared to actually transferring it officially.
Absolutely. It's critical that if anybody is considering transferring an ISA from one product to another, they follow the process that's outlined by each of the ISA providers. So for example, if somebody was looking to transfer into an IF ISA, generally you'll find a transfer in section, follow that. Don't take the money out of the ISA and put it back in. It starts to create all sorts of problems. You might lose the tax status of it, etc. So, just something to be really mindful of. But overall, once you understand exactly what needs to be done, it is, a fairly straightforward process.
Perfect. Simon, any additional comments? I guess, are we being too obvious by saying there is a £20,000 allowance, and if you don't use it, it is effectively lost? It isn't rolled over?
No, I don't think so. I think that 20,000 is a good chunk of cash. It's a good opportunity to wrap that away and keep it tax protected. But I think, to reiterate what Craig said, I think the fundamental play here is that you have the ability to transfer across all platforms within that wrapper. So you can move your cash war chest if it is overweighted, and you can move that to an IF ISA, or as you say, you don't close it and open it, you transfer it, and the process is fairly slick. So I think that's important. I think the other thing to consider as well from a stocks and shares perspective is that as an investor, you will have equity exposure, I'm sure, outside of the ISA wrapper. So not only do you look at whether your stocks and share exposure within the wrapper is overweighted, but you should also, I think, include the fact that you have stocks and share exposure outside of the ISA wrapper. And again, it's still subject to volatility. So, does that then give you the opportunity to perhaps consider the innovative finance ISA as an option as part of a balanced portfolio? But I think it depends on people's risk tolerances, on their savings war chest, their financial goals, and of course their personal life circumstances at the time. But you've got cash ISAs are a safe haven for cash. Stocks and shares ISAs, I think, are probably more of a medium to longer term play. The IF ISA is an alternative, or an attractive alternative product, because it also helps invigorate the local and the national economy. These schemes are investing in green energy. They're investing in, a much needed housing stock for the UK. And it's one way of providing funding for the property developer and the environmental developer, where perhaps some of the main high street banks have steered clear of that from their own risk perspective, given the economic circumstances as we see it. So I think there's perhaps an ethical opportunity here to invest and have an impact at the same time.
That's fantastic, Simon, and I think opens up a separate discussion and session on impact investing and the role that can play in a experienced investor's portfolio. I think we've done a great session here looking at the ISA options for experienced investors. I was going to ask if there are any closing thoughts from yourself, Simon, first, but you, Peter, have just done a fantastic job of summarising the whole ISA portfolio for experienced investors. Craig, any comments from yourself?
Yeah, I think the point that you made, Dan, the tax year ends nearly upon us. So, 5th of April, if you've got your tax allowance or your ISA allowance and it's unused, then really now's the time to get that money into the ISA wrapper. Obviously, it resets on the 6th of April. So, people who have got cash available and want to, again, get it inside that sort of tax-free wrapper again can do so after the 6th of April as well. So I think that's the critical point. And I think just echoing Simon's, points that he made around how you can balance your portfolio, not just across the ISA side of things, but if you've got a SIP or a SAS, or you've got, a standard pension, which might have exposure to the equity markets, it's looking at that holistically and giving you the opportunity to maybe use the ISA wrapper in the right way to create that balanced portfolio. Yeah. So I think it's a really good point.
Craig, Simon, that's been fantastic. Thank you both for your time today.
No, it's a pleasure, Dan.
Thanks. See you, Dan. Great, Craig. Thank you.